You won't believe it. Trump just dropped a jaw-dropping statement that's sending shockwaves and pure terror across the nation. Stay tuned. I'm your host, Steve Metre, and thanks for joining me today. In our show today, the alarm bells are ringing as Trump's terrifying remark is causing widespread panic. And this at a time when consumers are witnessing economic conditions that are strikingly similar to the harrowing days leading into the global financial crisis. And while global markets may be shaky, our tariff-beating trade is defying the odds and soaring higher, making our subscribers rich in the process. Stay tuned to the end of the show where we're going to break down how we do it and how you too can join in the action. Now let's head over to Bloomberg, where we picked today's story with a headline: as Trump calls for lower interest rates as Powell heads to the Hill to testify again now today in front of the House. And it wasn't long ago that President Trump said that he was okay with the decision to keep interest rates steady, that he actually said the Fed made the right move. Now he's saying the Fed needs to lower rates, and there's a shocking reason why he's saying this, one that most consumers are not expecting and not happy about. Interest rates should be lower, something which would go hand in hand with upcoming tariffs, he said. And the key words here would go hand in hand with upcoming tariffs. Now, we've heard some people say that tariffs are not going to cause prices to rise, but the prevailing view by most experts is that if you put a tariff on, the price of the goods has to go up. And this is a problem right now because American consumers are already reeling at the face of rising inflation. Their wages aren't keeping pace, and this is a big problem because it goes back to the same setup we saw heading into the global financial crisis. And so when you understand what Trump is saying here, he wants the Fed to lower rates because he believes that if the Fed lowers rates, it'll stoke demand, and that will offset the rise in consumer prices that we now should expect to come. And let's take a look at this chart here as we see that rising prices lead to weaker demand. As we look at real retail sales in blue, this is inflation adjusted against the consumer price index, that's shown in red, both on a year-over-year rate of change. If we go back to the late 90s, what do we see? Real retail sales are rising at the same time inflation is, and then all of a sudden there's a problem, and that is consumer prices start to get too high, and real retail sales growth slows and eventually contracts as we head into the dot-com bubble. And we move forward to right around 2005. What do we see? A sharp jump in inflation leads to lower sales. So you have this situation here where there's price sensitivity among consumers. There is a limit to what they can pay for, and when you see, of course, prices jumping and demand falling, it's not a good sign for the economy. In fact, it usually tells us we're heading into recession, but not every time, as it didn't in 2005 and 6, but that would only foreshadow what was coming in the global financial crisis. And the only reason the economy was safe is because there was a big drop in inflation right around late 2006 into early 2007. But inflation took off once again, and real retail sales went down. And I want you to think about the knock-on effects from the economy, because if sales are going down, what does that mean for businesses? Well, that means they don't need more inventory, so they're not ordering as many things from the factories. And if factories aren't getting orders and they don't have a backlog to keep their workers busy, well, it means hours worked and jobs get cut. So you can see just how critical this is, that when we hear that prices could go higher, why President Trump wants the Fed to cut rates, because back in 2011, we saw a big surge in inflation and led to a slowdown in real retail sales. In fact, we almost faced a double-dip recession then. And now look where we're at. We have 3 years of nearly negative real retail sales. At the same time, inflation has just been an issue and now looking to head higher, just as we've been predicting that it would. The problem is it does not signal any good news for small businesses. As we look at a net negative, if 14% of all business owners, this is from the recent National Federation of Independent Business survey, reported higher nominal sales in the past 3 months. So a net negative means small business owners are already seeing consumers pull back on their buying because prices are too high, wages aren't keeping up. And this is down 1 point from December. A net percentage of owners expecting, meaning looking forward, for higher retail sales volume fell from December's highest reading since January to a net 20%. So still 20% of business owners are optimistic things are going to get better, but at the current time, things are actually getting worse. And this is a problem because if we see higher prices, we can expect the reaction from consumers to say, we can't afford it. And Trump in a subsequent post sought to blame the persistent inflation on his predecessor, former President Joe Biden. And this is a dangerous game because you don't want to stake your presidency on something you don't have control over. Now, here's what I want to know from you. Do you believe the president has ultimate control over inflation, or is it his policies, or perhaps they don't have control at all? Weigh in the comments below. Love to know what you think, because let's take a look at where the economy is headed. We talk about the harrowing days heading into the global financial crisis, and there's some major risks here for Trump's second term. And when we look back to the late 1980s, and what do we see? Rising inflation here in red against continued unemployment claims in blue. And what happens is continued claims start to rise, and that sends us right into the recession in the early 90s. And there's two ways you can deal with inflation. You can increase supply, which would then bring prices down, or you can have a labor market recession, which would send people to the unemployment line where they cannot afford to keep spending. Both lead to lower prices. The problem is one leads to recession, and that's not a good thing. Let's move forward to 1999, where inflation takes off. At this time, the labor market breaks. Continued unemployment claims head high right into a recession. That was the dot-com bubble. But how about around 2006? We get a big drop in inflation. This really helps the economy. The problem is it wasn't enough. At this point, the labor market was coming to an end. What you see is continued claims start to head higher. Next thing you know, inflation back on the rise. That, my friends, is called stagflation. If you want to understand why people are struggling right now, is they're seeing prices go up and they're seeing their opportunities in the labor market getting weaker and weaker. And this is a problem because we talked about in yesterday's show how average weekly hours are declining. This means even though people are making more money in terms of getting wage increases, they're not getting enough hours. Their paychecks are actually shrinking here. And look at where we're at now. We see inflation did come down. We saw a big disinflationary push, and then the trend continued at a slower pace, but now it's heading higher. We predicted this would happen. The problem is continued claims rose, and they're continuing to move higher. And we can go back at these previous inflection points, and we can see that there is a point where everything starts to fall apart. But one thing that should be booming, that is your trading account. Let's talk about our big trade on GDX. That's large gold miners. We told our subscribers to buy here, and we're trading today. Look at that big green candlestick. It's up. Now, if you want to make big money in the markets like our subscribers, you have to buy in before the big money and sell before they do. But the big money is all controlled by formulaic machines. We've reversed engineered that. We call that our CTA Time Pro, and that's how we have such great success, showing our subscribers how to buy in before these big moves. And here's the thing, you can too. Stay tuned to the end of the show or check out the description. Grab those coupon codes for a 30-day free trial. And why 30 days? Because we're so confident you'll make money that you'll keep subscribing. Because Trump's comments now mark a shift from remarks earlier this month when he indicated that the Federal Reserve had made the correct decision, saying that holding the rates at this point was the right thing to do. Now, you can only imagine that this was a matter of time that he was going to change his view on this. And I was actually surprised when he came out and said that the Fed was actually making the right decision, because we know the Fed never makes the right decision. That's always the issue. They're reacting to the economy. They're reacting to the data. And the problem is that with particularly the labor market data, well, it's outdated and it's inaccurate. You look at the inflation data, it's lagged. In fact, everything the Fed does is with lagged data, and that's why they react. This case, the Fed saying we're on pause because we think inflation is too hot. The reality is the Fed has no clue what they're doing. Most mainstream economists say those measures, in referring to the tariffs, threaten to raise pressure on inflation, a major worry for voters and one which helped propel Trump's return to the White House, because indeed consumers need to see inflation come down, or they need to see their wages go up. And we've looked at some recent surveys from the Conference Board and University of Michigan, and what have we heard consumers saying is they don't believe that the labor market is that strong. They see prospects for increasing wages plunging to levels not seen since the crisis. They're worried if they lose their job that they're not going to have an opportunity to get another one, because we're seeing structural unemployment issues where people lose their job and they go on unemployment for 3 months or more. And this is an issue. If prices don't come down fast enough and very soon, well, it means we're heading into stagflation, just like we saw right before each and every recession, setting up a potential financial crisis on the horizon. But let's take a look at the issue consumers are facing right now as we look at total incomes. This in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees against the consumer price index. That's shown in red, both on a year-over-year rate of change. And so the issue you have isn't that inflation rises, because you go back to, say, 1996 and 1997, what happens? Total incomes are growing. The problem becomes when incomes stop growing and inflation continues, you go right into a recession. And we can see that happening again around 1998. Both incomes and inflation are rising, and it's not a problem until inflation rises too fast and income growth peaks. And next thing you know, we're right into the dot-com bubble as incomes are decelerating. And look at what happens right around 2006. That big drop of inflation helps a little bit, but income growth continues to decelerate, and then inflation takes off right into the global financial crisis that almost spurs a double-dip recession on the back that in 2010, incomes peaked once again, went on a massive deceleration as inflation took off. And here where we're at now is incomes have plateaued. They've been on a big downtrend since 2021. The fear is they're going to roll over and head lower. At the same time, inflation's going to head up. And the risk is, as you see with those gray shaded bars, those are headed right into another recession. The question is, can the Trump administration turn things around fast enough, or is it already too late? Weigh in the comments below. Love to hear from you. As we now turn to the inflation data, which top forecasts bolstering case for Fed to hold, meaning no more rate cuts, and that's not a good sign. The economy desperately needs them. The stock market had a big negative reaction to that, and we'll talk about why that is. Of course, we know President Trump saying, look, Fed, you need to cut rates here because I'm going to put on some more tariffs, and we now know that the expectation is prices are going to go up even more. Consumers not in a position to absorb that increase, particularly as the labor market continues to weaken. The consumer price index rose 0.5% last month, the most since August of 2023, and led by a range of household expenses like groceries and gas. And you talk about the consumer, the everyday American, what they're dealing with is rising grocery prices. This is a huge problem. There's nothing they can do about it. Rising gas prices. Well, you can try to drive a little bit less, but it doesn't change the picture because both of those are big variable costs in a budget. When they go up, you get less discretionary spending. This is a major issue here. And shelter accounted for nearly 30% of the advance, meaning that rent prices on the way up as well. So you talk about the issues here, and we warn that manufacturers said, look, our input prices went up and we're not going to eat it at the margin. We're going to pass this on to consumers. You're now seeing that show up in the consumer price index as well as across the services sector. Let's take a look because excluding often volatile food and energy costs, the so-called core CPI also climbed by more than forecast. And this affects everyone, even though the government doesn't think things like food and energy impacts everyone. Yes, I suppose they believe that you can eat less and consume less energy, but we know in reality that that's not true. But the issue here is the core CPI also on the rise. But look at this. It reflected higher prices for car insurance. That's going to impact every household. Airfares. Now, not everyone has to fly and go on vacation, and a record monthly increase in the cost of prescription drugs. Of course, that affects many millions of Americans. So you see prices rising. The problem is incomes aren't, the labor market not in a place of strength here. And Wednesday's report serves as further evidence that inflation progress is in the danger of reversing and going to head higher, which combined with solid labor market, well, if you believe that it's solid, and I don't, will likely keep the Fed on hold for this foreseeable future. Policymakers are also awaiting further clarity on President Trump's policies, particularly with tariffs, which are already causing consumer inflation expectations to rise. And so if people believe prices are going to go up and they can't afford them, what are they going to do? They're going to buy what they can now, and then they're going to go on a spending strike. And that is going to be a problem that we're likely to see in the data in a coming month. But let's take a look at why inflation is indeed going to come down. Now, it may go up in the short term over the next couple months, but why are we going to see inflation eventually trend lower? Well, let's take a look at average hourly earnings and production of non-supervisory employees. That in blue against the consumer price index in red, both shown on a year-over-year rate of change. And here's what I want you seeing. When incomes are decelerating, people can't afford higher prices. And yes, in the short term, prices can rise, but at some point they're rejected and they start to come down. Now, then a lot of people don't believe that that actually happens because they think, well, business owners will continue to raise prices. But if you've ever had a business, it's real simple. When your inventory is stacking up and collecting dust and not moving, and you still have bills to pay like rent and salaries, and of course, your own pay, well, at some point, you lower your prices to increase demand. That's exactly what we see here. In fact, we can go forward to around 2001. What do we see? Decelerating incomes, decelerating inflation. You see the same thing happen around 2006. Hourly earnings start to go down, inflation pops up and then comes crashing down. You see that big move in inflation right around 2010 gets rejected. You see it happens again in 2016. Inflation pops, but consumers say can't afford it. And now we're facing rising inflation at the same time that average hourly earnings are not moving markedly higher, meaning any increase in prices here is going to be rejected by consumers. The risk is, again, you go to these points where you see rising inflation against slowing average hourly earnings, you tend to get recessions, or at least the case around 2010 to 12, the fear of a double dip recession. And so now the risks for the U.S. economy are getting worse. And this is the issue that consumers are facing right now. They're worried because they're seeing the same thing happen that they've seen over and over. This time we have massive amounts of debt and at very high interest rates. And a Fed that says, well, inflation matters. Well, it doesn't, but we'll continue because from the Fed's perspective, they say it matters. I'm going to show you why they have nothing to do with it. Let's first talk about the stock market and why it has a negative reaction, because the S&P 500 opened lower while Treasury yields and the dollar spiked. Interest rate swaps showed traders are only expecting 1/4 point Fed cut rate this year. Before the CPI report, traders were leaning towards 2 cuts. Well, the reality is we're going to probably have more than 1 cut and probably more than 2. But let's talk about the NASDAQ here. As we look at the NASDAQ 100, shown in red against average hourly earnings of production non-supervisory employees, still shown in blue on a year-over-year rate of change. And what happens? You get a deceleration in earnings. Well, stock market tends to come down. You see that happen once again right around 2007, going to 2008. Earnings dropping, stock market goes with it. You see the same thing happen in late 2021 going into 2022, and then all of a sudden somewhere in late 2022 investors said, oh, forget that, we're going to buy and buy like crazy. Stocks took off. But look at this, average hourly earnings continue to decline. Now, why is this relationship to what it is? It's real simple. When prices are going up and incomes are going down, that means consumers have to spend less money on the discretionary side of the economy. It also means they have less money to invest in stock market. And that's a key point here. What we could be facing is a near-term reversal of what seems like the beginning of a next big bull market to most investors. So for how long you expect the Fed to be on hold going to this report? I think it only lengthens that time frame. That is, if you believe that the Fed really actually cares about inflation, and they don't. As we take a look at the federal funds rate in blue against the consumer price index, that's still shown in red. And what do we see? Going back to the late 80s, the Fed's cutting rates as inflation's rising. And in fact, how about in the mid 90s? You see inflation going up, Fed cutting rates. In fact, right around 2001, the Fed says, hey, we're going to cut. Inflation still persistently high. In fact, going in global financial crisis, inflation is surging out of control due to rising energy prices, and the Fed's aggressively cutting. In fact, they cut before the pandemic, and now they're saying we can't cut anymore because inflation is going to go up. Inflation only matters until it doesn't, because from the Fed's perspective is they use it as an excuse when they don't want to cut rates, so they're uncertain. They say, well, it's probably due to inflation, but clearly the charts show there's absolutely no correlation between inflation and the federal funds rate. It's only a matter of time this year before the Fed is back cutting. And this time, it'll be even bigger than before. Excluding housing and energy services prices also jumped 0.8%. And what did we talk about? Service providers said, look, we have to give our employees bigger wage increases, and we're going to pass that along to consumers now, right into the data. This, the most in a year. And while central bankers have stressed the importance of looking at such a metric when assessing the overall inflation trajectory, they compute it based on a separate index. Of course, it doesn't really matter because policymakers also pay close attention to wage growth. But if you look at the charts I just showed you, you can see that policymakers don't pay any attention to it. They think it's too high. What I'm suggesting is, yes, maybe on a historical term, wage growth is high, but relative to inflation, it's way too low. And that's the issue here. And in fact, the main engine of the economy has everything to do with expectations for consumer spending, which I think are going to drop in a big way. But check this out. A separate report today combines the inflation figures with recent wage data showed that real or inflation-adjusted hourly earnings grew a mere 1% from a year ago, and that's not going to boost the economy, my friends. But let's take a look at that inflation beating trade, now up 13.04% as of yesterday's close and surging higher today. And this is really simple because you want to trade ahead of the big money when it comes to buying and get out before the big money sells. But today the big money is all about the machines and the formulas run. But we've reverse engineered it. Here's the best part. You don't even have to read the report because we give you the notes every day. We say, hey, look, GDX, this was from back on January 10th. We said, buy it open. Here's your upside target. Here's your risk control levels. You just place the trades and then kick back and watch. We tell you when to raise your stops and where to put them. To date, we're seeing a massive move higher. Here was a report back from the 10th. Again, you don't have to read the report, but for those who want it, we give you all the data. Here you can clearly see GDX as a recommended buy. We reviewed the trade and said you need to take it. But here's the great part. You don't have to know how to beat the machines because we do. We give you the daily report, the tradable signals. I go through every trade and give you my opinion on them to help you be a better trader. And we've back tested them. We give you risk control levels, full weekly update. And the best part, you got a 30-day free trial. So you can try it out, start making money just like the rest of our subscribers without putting a penny in our pocket. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.